It's always important to diversify. We're great when stuff is volatile. We're not so great when stuff doesn't move. And that's where options are so beautiful.
Can you play everything in this? How diverse is that array and how do those correlate on a day-to-day basis?
What I enjoy about futures is that there's a ton of data on price action, really, and it's pretty easily available data. So that's step number one. Step number two is, I think that when you understand how markets are created from a microstructure perspective, why do they move and how do they move on a tick by tick basis, you can start formulating on a granular level where expected value and asymmetry are at their extremes. So let me give you an example as a little kind of in-depth into how we work. So we at Athena use something called absorption fairly frequently, which is in essence the ability to see where liquidity, so where market makers are supplying liquidity, where they begin to have asymmetric information such that they offer more liquidity than usual. Like they've almost taken their own position in the market, right?
Yeah.
At that stage, we also get a firm understanding that traders can't move through that liquidity. So there's now this imbalance between active traders, namely buyers and sellers, whichever direction you want to pick. When you do that on a tick by tick level, you're then able to risk, ticks to make tens, if not hundreds of ticks in the opposite direction. So that's where that level of asymmetry comes from. It does rely on a little bit of financial engineering when it comes to the leverage side, because to gain a meaningful return on those tiny, tiny movements, you need to use the futures contract. That's what they're built for. But at the same time, each of those positions need to have a built-in risk parameter, i.e. stop loss. We're massive on risk management. So that's really where we drive our edge in the futures space.
In regards to that stop, I think this is kind of an interesting place to go. Is this a gradient? Like the signal gets stronger and you size up, or it's just like we're always sizing the same amount, and since we have an asymmetric risk to reward, we'll hit 1 in 50 that are asymmetrically larger, and we're just comfortable taking static risk periodically?
Not quite. So the strategy could work with a fair amount of potency if we kept the risk static. What we then layered on top of that is our version of asymmetric bet sizing. So not all trades on all days are created equal. There are going to be some days where your edge is far more potent, and there are going to be days where your edge is maybe more diluted. Think of volumes, think of liquidity that you aren't able to, that you can't read, for example. So we have a standard size that we tend to use when, performance isn't diluted. When performance is diluted, we then scale down extremely aggressively and as quickly as possible, such that once performance increases, that drawdown is minimized and we're able to get back to square one as quickly as possible. We tend not to size up from that baseline, but rather allow for natural compounding to occur throughout the period of a year to avoid volatility drag, which we actually spoke about. You sent me the Shannon's Demon article, which was incredible. Yeah, tell me a bit about that, actually. So how did you come across that? And is that applicable to what you do or no?
I think that when we are playing in shorter dated stuff like me and yourself, there's much more edge to be derived off of the compounding and protecting against risk than there really is in the actual instrument. So there's basically an unlimited amount of edge in futures options and contracts, in options contracts. So if we could just derive and this sounds crazy too, but even with options, it's like that. There's enough edge in just a put option market quoted price. It's just, can you protect against from the drag on that to basically realize it? So I'm always kind of curious of what people do and how they size, because we're sizing the same because if it hits, it asymmetrically picks up. We're just positioned for that. Whereas futures, the other thing that's part of this equation is what's the drag on it? So can you play everything in this, or are you kind of limited to crude, euro, gold, and ES and NDX? Or how diverse is that array, and how do those correlate on a day-to-day basis? So now if we talk about portfolio construction, I guess.
Yeah, and that's such a great point, especially on the correlation side. So theoretically, this is something that we can play on pretty much any market, as long as it is fairly liquid. The illiquid stuff, obviously, it's very difficult to read.
How do you define fairly? I guess futures contracts,
Yeah.
it's not the option or quite.
Yeah, yeah, yeah.
Yeah.
On futures, like at a very basic level, I'm trying to keep this as layman as possible because you and I can chat financial
No,
terms and
you might
whatever.
as well go into it. Like we'll cover more basic concepts, but you might as well nerd
Mm.
out on like
Okay, all right, for sure. So we tend to keep it very basic. So what does liquidity look like for us? We don't like seeing gaps intraday, to be honest, because the
okay.
moment you start seeing gaps, it means that liquidity providers and market makers aren't able to fulfill, a certain price without breaching their risk in some way, shape, or form. So when you look at things like crude, natural gas, ES, those are super liquid instruments. We kind of draw the line when we get to natural gas because there are often times where you see these gaps in price, especially when stuff gets volatile, but it's not big enough to, warrant getting slipped or being, or having a stop executed at the wrong price such that your risk is breached kind of thing. Um, to answer your other question, as far as what we can trade on, again, it is subject to liquidity because we have to see at a very detailed level what that relationship between market makers and active traders looks like. That's really where all the
It's
edge is
bad
defined.
data when it's not liquid. You can't really
There
trust it.
you go.
Yeah.
Exactly.
Um,
Yeah. Yeah.
so going back to this concept of when you're taking signals, so you could just predict this by price action, or you see like the behavior of the price action. You're saying, market makers are basically delta neutral. So if it goes, they're going to hedge in that direction and exacerbate the market. Like kind of that's what you're looking at for it. And then is this one thing I like to kind of misnomer is like it's usually not some AI learning model. So you guys have like a back tester based in Python, or what are kind of the inputs to making the decisions?
Yeah. So there's two components to what we use to make the decisions. The first one is asymmetry. Asymmetry doesn't rely on any of the relationship between active traders and market makers. That's just what we derive as expected value. Where can we find edge at the most extreme parts of the day such that, we're only taking the best of the best setups, The second part of that is the order flow side. Order flow is where we're monitoring the interaction of price and volume at very particular levels, i.e., the levels that we determine are fit from the asymmetry side. How do we do that? We are looking at the rate of change of price, we're looking at the rate of change of volume, and we're looking how much of that volume is done on the bid or the ask. The intersection of those is where we're able to find our special blend of prediction, i.e., are we able to risk one to make potentially 3 and 5 on a consistent basis, for example. Initially, when we didn't have the order flow stuff and we just focused on the expectancy, we were trading, many times a day and often, on one instrument because it sucks your focus.
Yeah.
But the expectancy wasn't amazing. There were a lot of trades that we realistically shouldn't have taken. But when we started combining that with the actual data that comes from, again, volume, price velocity or momentum, and what percentage of that volume is done on the bid and the ask, we're then able to go, okay, we've got a level of asymmetry that works in the strategy. Now let's start using order flow to remove the duds. So in the expected value formula, we basically increase the hit rate side while maintaining the high RR side, if that makes any sense. So
Yeah.
that's really how we played it.
And in terms of occurrence, what is looking for those A plus setups or whatever look like? Like how quick are you turning over positions and capital while doing this?
Look, the average trade lasts about 6 minutes. It's not
Okay.
long at
And you're
all.
taking dozens of those a day, I'm assuming.
Not actually dozens, funnily enough. Maybe, look, across the team, we're taking maybe a dozen across the team.
Mm-hmm.
On an individual level, we try and limit each instrument per day to two. You don't want to be trading everything. You want to be trading the
Yeah.
most high quality stuff on the day, which is extremely correlated, by the way. Like everything
All around the
on
same
most
time.
liquid markets, they all move at the same time because obviously market makers are hedging, right?
Yeah.
If they're taking risk on stuff, they have to hedge it in something else, which is going to start driving price. But that said, yeah, I mean, it's two instruments. And if you're getting like 4 trades in a day, that's a lot, per guy. You really are starting to push the limits of what's acceptable.
And then is more volatility better, or that kind of makes it harder to derive data because there's just not as much going on?
No, not quite. More volatility generally means high hit rate for us. Again, why is that important? More volatility in liquid markets generally means more volume. So more active traders, that's what that means. When we've got more active traders, that picture that we can put together of the market makers or liquidity providers and traders becomes extremely clear. And the moves that follow that become extremely clear and extremely defined. The problems come in when you have a pretty unclear picture of market makers because their picture is inherently unclear because they're always taking on and putting off positions. And then you take traders who aren't really committing. No one's pushing big size. Market's very difficult to get involved with.
So then now, are you guys going to stay in that, or do you really think this is the sauce and now you're just in the scale component of it? Because I imagine with futures you can basically go indefinitely with it. So like drawdowns, you're not really worried about. Liquidity and size, you're not really worried about. And in terms of these like positions, you take what, are you like 1% of the open interest on them as well? Like you got plenty of room to scale.
Yeah, we got tons of room to scale. It is the source for us right now. But with that said, I think it's always important to diversify. So we're great when stuff is volatile. We're not so great when stuff doesn't move. And that's where options are so beautiful. Because if you can structure your options correctly, you can make money during times of low volatility, which is something that we actually encountered about 2 years ago in FX markets. Actually, this time last year in FX, volatility dried up across the board, especially on your majors. And that's actually what drove us to trading a little bit more of the crude oil, commodities, and kind of equity indexes side of things. So yeah, scaling now, but also open to the idea of options. Speaking of, by the way, were you on the desk today?
Was that what?
Were you trading today?
Yeah, I trade every day. So I mean, I had positions overnight because I run like a financed hedge, and it's like you always get bit on the first leg down. So it's like long puts canceled out majority of the loss of short puts, and it's like a little under market down. But in general, vol is very beneficial. I think, like, yeah, I mean, this market's quite bullshit. I think everything's going to be rolling over here before we know it. And I'm excited to provide some comparative alpha as opposed to the last 2 years. So what has your experience been with like, I'm trading all this leverage stuff and whatever, and then we're looking at people that, just buy the S&P and are returning 30% compounded year over year. What do you think of the appetite in the space, or where that goes kind of in the future compared to the timeless futures trading?
Yeah, it's a great question. So I'm gonna kind of pull that into one question, which is what do I think of what you and I are doing versus the average guy that's basically just long S&P with a bunch of leverage, right? Let me put it this way. I grew up watching films like Limitless, where you had Bradley Cooper, who was nothing. He takes a pill, he made something of himself, and he became an incredible trader. And he made money for people, right? It was a very small part of the film, but as a kid, I watched that, and I immediately constructed this idea of what our game looks like. And that is, you want to get from bottom left to top right in as steep and a straight line as you can, right? That's what these guys are paid for. The reality of that, and you'll definitely attest to this, Mark, is not the case. You've got guys taking out enormous amounts of leverage. Their reporting periods are super wide, so you don't get to see the intraday volatility. It doesn't make a lot of sense, right? Clients don't actually know how at risk they are. And it's a shame because there's so many long, short equity and CTA guys out there that are just on that basis. The moment you mention a lot of anything that's outside of long, short equity, especially leverage levels above, call it 30% of AUM, clients get scared. And to a degree, rightly so, right? Leverage is a very dangerous thing. We liken it to a katana. But in the right hands, it is an incredible tool. And that's really where a lot of our alpha is generated, between you and me, Mark. I think right now the sector has really just got, for the most part, a poor understanding of what real asymmetry looks like. A lot of clients just care about, max drawdown and profits, and they don't mind a fairly wide reporting period. Whereas there's actually better stuff out there if people educate themselves and get a better sense of, what real quality looks like.
And what do you think that metric is for quality, or the like metrics that you would advise people to look at to determine if people know what they're doing or they're not doing? Because I'll tell you, for me, it's like anyone who touches an individual stock doesn't count. Just in left field.
Yeah.
I don't know if they're doing it.
Yeah.
Sorry, can't do it. And then even because you're playing with multiples, which is just no longer relevant. And then anything that's an extremely long time frame. So it's that doesn't really matter. Whereas if you start to get into someone, it's we do dispersion, it's that can obviously blow up, but in general, that's okay. Or they're doing some carry trade. And then the thing, I actually don't even like Sharp. I think that Sortino, the other thing too is I think we're best suited to be actually just income generations. I'm actually not trying to manage 80% of someone's net worth. You know what I'm saying? I was allocate accordingly. It's if the exchange shuts down, I could take a very large drawdown, but outside of the exchange shutting down, which may happen once a decade or every 20 years, it's I'm going to get as close to that line with a quarterly target for income. So it's I'm a better option than real estate, because if interest rates double, I'm just collecting the extra interest on my account in 12-month treasury. So I think the big things, it's I like Sortino, unapologetically, what's your return target on a source that is a year or below, basically, and what you quantify as your benchmark. You know what I'm saying? It's I think everyone should benchmark themselves to S&P, because that's the most liquid, cheapest return. So it's you got to beat the S&P, and nothing's wrong with taking on 0.3 correlation to hold something that's systematically long ES or something,
Dude, 110%. And I think you touched on something interesting there about Sharp specifically. Because if you look at the formula, Sharp penalizes you for upside volatility.
Risk to reward, yeah. It's I've run optimal Sharp on Python, on a Google Colab, factually the Nobel Prize winning equation, and it's worse than what I can balance in Excel, because it punishes asymmetric reward. So it's Sharp is for long short equity, and it's irrelevant. My Sharp, I think, was 1.6, and my Sortino was 4.6, and it's my Sharp worse than S&P,
Yeah, dude, 100%. So I mean, the approach that we take, and the approach that we've seen the really sophisticated guys take, is they look at Sharp for return consistency. It's not everything, okay? They just want to know how consistent are the returns.
Yeah. You should be around 2. Yeah.
Yeah, and that's good. If you're around 2, excellent, well done. If you're an income generating fund, maybe you want to consider that a little bit more. Think about trying to collect premium off a specific strategy that's maybe not linked to premium directly, then Sharp, but loosely consider it. Secondly, for the more asymmetric stuff, like you and I, Kalmar and Sortino.
Yeah.
Kalmar, a direct realization of what your actual risk that you incurred was, that you need to be paid for. Love it. Sortino, again, same as Sharp, it just doesn't penalize you from making that asymmetry along the way, right? The last one.
Here's another one. I'd be curious what your opinion is. So I it's a function of Calamar and Sortino or whatever, but it's what's your average daily return and what's your average daily standard deviation, and then what does that look like over 250 quarters in a Monte Carlo situation? So it's it gives you a 95% certainty if you're actually in between your intervals, because it's now one, because that can really start to show you what does worst case look like. And in all honesty, I think it's drastically overstated, because I guess crude can go to 0, but ES can't go to 0. So it's the 3 and 4 standard deviations is kind of not even possible in the data set. But I think that's a very valuable insight, because it's okay, what does this look like? And actually, now we're talking about the other thing that brings it up too is I think the trade-off between correlation and beta is really important. So you can get more correlated to the market, but if it lowers your beta at a faster rate, you've got a better uncorrelated portfolio, which I think a lot of people miss because they just peg on correlation. Or it's private equity firms will say, we're uncorrelated. It's you take one data point every 4 months and
worth.
You know what I'm saying? It's
Yeah.
like
Yeah.
something that was worth 300 million bucks on your books, one quarter is worth $0 on your books next quarter. Yeah, okay.
Mm.
But yeah, keep going.
Yeah, that makes complete sense to me. I want to touch on the Monte Carlo stuff though, because this is something that we play with a lot in our strategy generation. And here's the interesting thing about Monte Carlo. It doesn't take into account exogenous risks, which is pretty much, yeah, which is the risk that you and I face when it comes to trading derivatives.
Yeah.
Do you know what I mean? Like we can go, I mean, in our fund, for example, we cut off everything that happens at negative 15% net asset value, because at that point, everyone gets redeemed. We don't want to be involved at that phase, because by all like standards, we failed. The model has failed if we reach that point,
Yeah.
right? The only way that we could get there, and we've modeled this, it's not possible for us to get there because we use a very specific risk model that has a limit way above 15%, because we just keep halving our risk over time. So we kind of
Yeah.
tend to a
The
specific
absolute
point.
max drawdown method. Yeah.
Yeah,
It's
yeah.
like an
So we'll
absolute
never
max
get there.
drawdown. Yeah.
Yeah, the only way we get there is an exogenous risk thing.
Yeah.
What's also interesting is when it
Do
comes
you
to
protect against exogenous risk with any type of tail, or this is just an allocation and sizing from exogenous risk protection?
just allocation and sizing. I'm
Yeah.
thinking about how we can hedge that, but when you think about how you would hedge that, that's more an insurance policy that you would purchase from an Aon
Yeah.
if in case
I
exchanges go
mean,
down. Or
like, I think about this too, and it's like if the exchange shuts down, I'm a full buying power loss, and it's like if I'm using 50% of my buying power, it's like that. However, if the exchange is shutting down, you have to think you're at least -7. So, like, being long contractual units is the only way to
mm,
protect against. Even if you buy it for a penny, you know, like the cheapest thing down there, and it's like so my very controversial opinion about this is actually like
mm,
derivatives on assets that have basically zero volatility priced into them. So if you think about like what were rates priced at in 2021, like you could buy a 50 basis point move in rates for pennies, literally. So
mm.
even if those don't get rolled over in some risk event, the repricing of that from a 10 vol handle to a 15 can be like a drastic P&L
Yeah,
lead when it only costs you like a penny. So that's kind of like, but yeah, no, I'm with you. It's like if the exchange goes down, it's like that's why you own the S&P. The Fed will bail them out. It's like the Fed's not bailing me out or whatever. It's like the Fed didn't bail out crude either. It's like the only place you can park your money is fixed income and the S&P for that. And it's like allocate accordingly, you know?
yeah, exactly. I think there's also an argument to be made for the amount of leverage that those things can afford, and only holding on exchange maybe 20% more than what the leverage provides you to
Yeah.
fulfill those positions. You know what I mean? So again, just to really refine that, let's say that I've got 10 million, right? And I'm trading a total portfolio of 10 million. Because the leverage available on things like options and futures is so high, I don't need to hold all of that on exchange. I could actually take, 30% of that, 20% of that, even in some cases, put that on exchange, put the rest in some income yielding asset, think treasuries, if you don't mind the inflation, or even gold or diamonds in some cases. I've heard that there's some niche stuff that you can do there. You can get the same amount of exposure with less capital at risk on exchange and generate alpha in some other place. Again, that's also something that you can do to avoid that.
And this is like the ultimate kind of hedge fund hack too, is like since we're a limited liability company, if we had, let's say, 4 times leverage out in the market, we only had 20% of our capital in the fund, and some risk event happened that made us potentially owe the option clearing corp 10 times more than we held. They could only take you for the LLC. So it's like, this is actually what I plan to do. But I think the best solution for like a future fund is it's like in like your future fund, you just invest in the fund that actually trades the risk. So you have the protection of the LLC. And then in the current fund, it's like you hold treasuries in the SP and you're basically like, hey, this may have like a little higher volatility in Sharp, but what I'm not doing is I'm not taking 100% of your capital, exposing it to some risk event so I can get a prettier Sharp and like buy no protection. I'm having a regular 60-40 core in here that has no rate risk, and the Fed will bail this out. And then over here, anything we have risk, we have the protection of an LLC. It's like, I don't know why more people don't run a business like that because it's legally baked in that you're rewarded for taking
Yeah,
risk as a business owner, and you can basically just avoid that androgyny. And the other thing too is like, even if you're buying penny stuff, if the exchange goes down, can you even liquidate it? Like, like
that's
did
such a
you
good
hold?
question. Yeah,
Yeah, because I was holding VIX options on August 5th, and I did not get to liquidate them anywhere near a 65 handle. And like 2 minutes after the
yeah.
open, I liquidated them at like a 40 handle. So it's like, can you even like you can model that as much as you want, but like unless you're actually unless you're executing with some sales trader at the Citadel, I don't think you'll actually be able to execute.
Dude, and this is something I actually wanted to talk to you about. So, did you have a look at that link I showed you on Visual Capitalist?
Yeah,
Did you see the bottom section?
yeah, where it's like there's more risk and concentration than there's ever been in like solely those hands than anywhere before. Yeah,
Yeah,
and it's
it's ridiculous. So, I think just to give whoever's watching this just a sense, there is an incredible link on Visual Capitalist that shows you the size of various markets as of 2024. So they've got like gold, they've got the Fed balance sheet, they've got China's balance sheet, Russia's balance sheets, the S&P, pretty much everything that's worth considering. Right at the bottom of this particular document, they show the size of the global derivatives market. And it is massive. You are scrolling to just get to the bottom of this thing. And to put it into like a quantitative perspective or give you a quantum for it, the world's global debt, inclusive of corporations, governments, and individuals, is 300 trillion, right? The size of the derivatives market is 600 trillion.
yeah.
Now, when it comes to exogenous risks, I understand that we go, look, no one's going to bail out the CME. But at that kind of market size,
They're gonna bail them out. And
maybe they're
like
going to bail them out,
happened
man.
in 2020, it's like corporate debt all bailed out because it's like every bank has some swap, or it's like you even look at SVB's balance sheet from 2022. It's like they had I don't know you know $500 billion in like assets, and they had like $1 trillion exposure on interest rate risk because you're allowed to leverage it. It's like IB lets you leverage a treasury less than 1 year, which technically doesn't have any rate risk. It's really not sketchy, but 99%. So it's like
Mm,
it's instant, and everyone like I think people hype it up because I think the majority of that is on treasuries, where it's like people are just
mm.
borrowing derivatives to like sell a straddle while they own treasuries and whatever. But yeah, no, it's the most fragile thing that's out there. Although I think it's more balanced because there's more retail traders. I'm actually most worried for the brokers, which like I don't
Because
think they'll.
they internalize the risk.
Yeah, so like a broker, for example, like if you're holding Nvidia, they have some type of PM rule that they're potentially changing. And like let's say Jensen Huang got shot and Nvidia
Mm,
sold off 30%. It's like the brokers would be completely insolvent from that
yeah.
type of, thing that occurred. I'm not saying that you should be worried about that risk, but yeah, the derivatives market is the problem, and is what happened in '08 and whatever happened, but people are going to continue to do it. And I think a lot of people are actually protected well in it also because they own cheap, penny options.
Do you think that these guys own some form of credit default swap on themselves? Actually, no, you can't, can you? Because
I
then
do know
obviously,
that if you're a market maker and you have an exchange sheet at the SIBO, you're like, as part of that agreement, forced to own CBOE stock. So, I mean, ultimately,
I'm not clicking. Why?
so
Why is
like
that?
if you're a market maker, as part of your exchange license, you have to basically hold a certain amount of assets in CBOE stock. I mean, you're a participant, but like you're also in it. And then the other thing with this too is it's like I did a deep dive on what it looks like if things break. And like the three examples we have is like Black Tuesday in 1987. And it's
Mm,
like fundamentally they didn't price put options correctly. So it just like
yeah.
went down and there was no bid. And then we have like the flash crash in 2010, and it's like basically
Mm,
sold off 7% like 13 minutes, which I think would be okay for a lot of people, but like exacerbated selling could be more of a problem. And then we have like 2001, whereas World Trade Center happened, they moved up all of the expirations to expire like 4 days later when the market opened. And when the market opened, they just took whatever price the market opened at and said, hey, this is what all the option contracts settled at, which you could see could really screw you if you had a hedge that expired. Like if you had a short that expired on September 11th and you had a hedge that expired like 20 days out or something. And then we have Hurricane Sandy, again, New York based things where it's like they knew the hurricane was coming. They pushed up all the expirations and took the price before. So it's like they can either take the price right before the event, they take the price at the limit down price, or they could just make up what happened in between for the 4 days and take what the opening price is. So like they're the judge, jury, and executioner. And the way I basically rationalize this is like you should position to be okay in 3 or 4 ways. So like if you have short options in a shorter duration, and then obviously you're always capped with some type of vertical spread or notionally irresponsible. If the market is pinned at right before the drop price, you're good and your hedges will cover it. If it's pinned at the actual instantaneous drop price, you could be fine depending on what it opens up at. Or if it doesn't, you lose your full width. Or if they just pushed all the durations forward from the instantaneous drop price, you'd be fine because your long and short would be married to the same duration. So
Yeah,
like
I'm following
you can
that.
get screwed for sure.
Yeah, I was gonna say like that's something that's such an options challenge. Like that's not something that a lot of futures guys tend to encounter. I mean, look, we deal with margin changes, but I mean, we don't get anywhere near such that that ever becomes an issue. I don't know if there's ever any limit down issues on the stuff or limit up issues on the stuff that we trade either, just because everything's so liquid. That's not to say it can't happen though. But what I am noticing is that when it comes to the options market, there are a lot more risks that one has to consider in terms of variables to make premium. And I think that's a very option market challenge to overcome. Like there are very few other markets that have those kinds of risks unless you're doing financial engineering at an investment bank where you're making like super boutique products for, whatever company out there.
And they probably hedge with the contract.
Yeah.
The market's the other side. You know what I'm saying?
Yeah.
So that's why they move. And then the feedback loop is future contract. They go short to hedge, spikes implied volatility, which causes reverse ETFs to sell more volatility, which causes everyone else to up their margin calls, which causes more volatility, which spikes the price, which causes more shorting of futures. And essentially, this is the wag of the dog. But yeah, I think this week is interesting because it's like you have all the earnings and they're all going to come out and say, hey, we're going to spend $60 billion on power that we may or may not pay off on because that's what you guys have wanted. And then it's like all of a sudden, what if someone else innovates better than the giant tech monopolies? And also like Jerome Powell doesn't listen to Donald Trump and says, no, we're keeping rates where they are and we're not down them. So do you trade Fed days or any existential events like that, or like crude oil balance, or do you touch events?
Not really, just because liquidity tends to dry up. Like if we had a situation where I could, get a guaranteed stop, the asymmetry is huge. I could just coin flip and go, cool, risk 1 to make 10 and just coin flip it to decide. Unfortunately, we don't get guaranteed execution at those times because liquidity is so dry. You can go and risk 1 and end up risking 5 without you knowing because the stop isn't guaranteed. What's also challenging about trading pre-market with those things is generally there isn't enough participation for us to see with a decent amount of understanding and clarity as to what the market's going to do. Because all the traders, if you think about it, are waiting to reprice. As soon as that event comes out, the HFT guys get in first, then maybe systematic guys get after, then the discretionary boys, then everyone's involved. It's not as the market releases that data and then price stops to move in that initial kind of spike. We try and also limit our trading to the first 2 hours of market open, just because that's the highest volume you're going to see on the day, and that's the clearest the picture is going to be for you. So we try and tend to stay in that little window. What about you guys? In fact, what about today even? Like how was today for you with the whole DeepSeek debacle?
Dude, I just, it doesn't matter to me. It's like it's trading exactly the same. I've probably sold like 120 grand of premium since like today. I'm not even looking at it. It's all automated. So I'm really playing small edge compounded over an indefinite amount of times and just like protecting against risk. Like the first leg down of fall, is always like you're going to eat it because you sold the priced in vol. But then, so like market S returns the first leg down if it's overnight like this, and then it's significantly a better environment. Like I actually kind of saw this thing the other day, and I'd be curious your thoughts of it, where it's like people talk about volatility, where they're like, we want a 30 VIX, we want a 20 VIX, but vol at its core, like clusters, pops, and reverts. And there's low vol regimes and high vol regimes, but like the VIX systematically changes of what is high vol and low vol. So like '08 to 2010, the average VIX was like 30. And then 2015 to the end of 2017, the average VIX was 9. You know what I'm saying?
Yeah.
And then 2020, 2022 is high. So like, I don't think you can really, I used to think it was just high vol is better, you know, but it's just all implied versus realized. And obviously like bigger moves are always better, but we have such a small data set of what big moves are. Cause it's like, I wasn't trading in '08. There's no good data on what happened in '08. It's like, I think that was like people priced in fear and it happened. So I think it would be terrible. You know what I'm saying? It'd be 2 or 3
It's
times.
a self-fulfilling prophecy.
Yeah. It's, but all the other times vol, it didn't really end up playing out. And it's like COVID's kind of an example of that, but it's like 34% in 19 trading days. You know what I'm saying? It's like that. Yeah. That's quite crazy. So environment wise, I don't think there's ever a perfect environment. And this is like, sounds like similar to what you could do. Maybe you guys had options, but like, I like to think of it as what I call the dragnet theory. So it's like long vol is good sometimes. Like I sell a systematic 7-day straddle every single day. And last year it did like 3% return, which is nuts. If you believe in volatility risk premium, it's like a long straddle with no management returned 3% last year. It's like, that makes no sense, you know? So that environment is always going to change. And the more things you have long vol, something at the end of the day to something at the beginning of the day. And it's like, there's always things like options trade well at the end of the day because it decays into expiration. At the open of the day is an extremely good environment, especially when something overnight spiked vol is usually an extremely good environment for that. But when you have enough of those, the sums of the parts equate more to the whole. And it's like, you almost can't even contextualize why they're working. You're just like, I know these are 7 sources of edge. And when I combine them, they make a better part and a more consistent return. And like that makes a lot of sense.
Yeah, it's an interesting one because it also speaks to almost like a black box dilemma, doesn't it? Because if you've got all of these strategies and you don't necessarily know why they work, you know, for a time, absolutely, they can rake in profits and everyone's happy. But because you don't understand them, you also don't know when they can fail and how far they can fail. Do you know what I mean? And you can model for it. Don't get me wrong. Like you can definitely do that. I think the other commentary I have on the VIX is that it's almost like as the VIX has aged, there have been examples of where the VIX can be used and extorted for some, you know, X and Y purpose. As that's evolved, so the composition of the VIX has changed over time. It's almost like the purpose of the VIX has also changed. You know, VIX used to be realized like volatility.
It's not real anymore.
It's not real anymore. It's like right in the beginning, the VIX was in a very basic level. It was created to give people or individuals a sense of volatility. What is the sentiment towards volatility? What are we expecting, right? And generally, I think for a time that came true, right? The more efficient markets have become, the more leverage that's been added, and obviously the tech that's been improving, that shifted from, you know, if we're pricing in $1 of volatility, you're going to see $1 of volatility, to right now it's $1 of volatility, and we might see that priced in for the first 10 cents. But over time, you know, once we pass 10 cents, that level of volatility is going to decrease. So it really is something that you have to take with a pinch of salt. I think also with the level of leverage in the market at the moment, especially when you look at large balance sheets and the kind of catalyst effect contagion even effect that can have, it is a bit of a thumbs-up game when it comes to trying to predict volatility, because that's ultimately what the VIX is, right? You're trying to predict to what level that can occur. So it's a difficult game. And that's why we've stayed away from the VIX completely. I think it is extremely complex. I'm going to leave that to you, Mark. You are, you know, incredible at what you do, amazing at your game. But for us, it's really about just playing what's right in front of us. We don't predict, we purely react. And that reaction edge is driven by just, who's buying and who's selling and who's got more asymmetric info based on that kind of play between the two. It's very simple that way.
So another global concept that I kind of read about that I thought it was interesting, it's like the amount of leverage and risk appetite, specifically in young males like under 35, is at like higher than like cryptocurrencies, staking, options, like leaps in NVIDIA. And I was even thinking about it to myself, and it's like, so our parents, like baby boomers came back, the government bought them stuff, we had good industrialization, women went to work, it was the height of productivity. Then we had like baby boomers buy a house, like you get a pension at your job. And then our basically community is, it's like you could have worked really hard, gone to Stanford and been an engineer at Intel, and you're just making 300 grand in the Bay Area and can't even buy a house. Or you were a receptionist that like partied all weekend in San Francisco and just so happened to be working at NVIDIA and you're worth $25 million. So it's like the risk reward of gambling on financial instruments, I think, is quite better. And I think it's going to turn out very bad. And it's like, who knows, maybe I'm even the idiot that's holding the bag because I'm, doing it more professionally. But I'd be curious in like what you've seen from the risk appetite. And if you think that's like true, and if that's kind of changed market participation in general,
Dude, it's such a good point. And it's something I think about quite a bit when it comes to, again, just looking at like long short equity, CTA, global macro guys. Like you will always make money, at least on balance sheet, assuming you have infinite amounts of leverage and margin. Yeah. Right. So like the more of this
value positive strategies are just martingale the ball, continue to go it out, and buy low, sell high. Yeah. Two positive EV strategies, but do you have enough time and do you have enough money?
That's exactly the thing. Yeah, you're spot on. And if you look at the amount of leverage that's being provided over time, that's increasing, man. It's not like we just offered, cool, we'll do 2x leverage and maybe we'll consider 3. It's gone from 2 to 50 very quickly. And when you look at internalized risk, especially in the retail CFD sector, I've seen guys offering 1 to 2,000 leverage. Like picture trying to use that with some kind of like, again, hedging strategy or relatively small martingale strategy. Like it's a game of who can sit on the most money at the largest amount of time, right? Yeah. So as far as the risk appetite for males is concerned, coming back to a primary point, it's natural if you think about it. As humans, we're created to use tools. And if there's, a hammer and a chisel in front of me, and then, 5 meters ahead, there's a jackhammer, I think it's natural to use the jackhammer because it's going to make my life a lot easier, right? I can provide for my family, i.e. generate cash if I use the jackhammer. 1 to 2,000 leverage is an extreme example, but it demonstrates the point. I think it makes a lot of sense. I think what also is really interesting is the amount of DD that brokers do, especially in the retail sector now, to give people access to that kind of leverage is extremely small. Like you can open up a CFD. You're in the States, Mark, right?
Yeah.
Yeah. You can. Yeah. So you can't trade CFDs, but for anyone else who can, like it's very easy to get access to that kind of leverage on a very simple and straightforward platform. It'll probably take you less than 20 minutes to get done. So I think it's a natural progression, unfortunately. I also think the ones driving those tend to be bad actors too, if that makes any sense.
Buy my course, get the leverage. Or the other thing that I think of is it's in the hour between the dog and the wolf, which is like a book on risk management. It's like naturally like females are better investors than male because like the male psyche in the animal kingdom and the human kingdom, it's like take risk, prep with testosterone for that risk, take risk, are rewarded with more testosterone, which incentivizes more risk behavior. And this basically cascades so the alpha male is so reckless, parties so much, is so out in the open that they get taken off by the next person. And this is a story of every financial bubble. It's like it's such a natural human cycle. So I guess besides the data, how do you curb your, I don't want to say greed, but testosterone feedback loop when you're killing it and you're turning better returns and people are liking your good money flow. And it's like, what types of either mental checks, whether that be like yoga or something, or just like checks in your business do you have to combat against that?
Mark, that's such a good question, and I'm so glad that you answered. You asked this, and there's 2 points to this that I want to bring up. So the first one, actually, I made a LinkedIn post about this where I was trading crude oil last week, and killer setup. I could see the picture clearly, but then I realized I had the order flow, I didn't have the asymmetry part, and that technically is not what I sold to our investors.
Yeah.
That's a different product. I don't know what the expected value of that is. I could speculate for sure, but that's still not what I sold. Anyway, it was a great trade. It worked out in my favor. I'm glad I didn't take it. But it did prompt this idea of what you mentioned. Like, what happens if I took that trade? I've now not only given myself the testosterone boost, but I've also subconsciously told myself it's okay to break the rules. And number two, when I do, yeah, and I make money when I do it. So now I'm going to do that more often. Our approach, and I'm sure you'll, again, also, I'm sure you do this too, is when you create a strategy, you need to acknowledge when you see that equity curve at the end of your robustness testing and your live testing that you go, I'm committing to this equity curve. It is good enough. I don't need to add any more synthetic edge to this, i.e. make up trades, because that's where the problems come in. I also think that acknowledging that leverage is not a solution and you can't kick the ball down the road forever is a really important concept to have in our game. Because again, coming back to the CTA global macro guys and a lot of long short equity guys, you can't just keep levering yourself up with unlisted reportables to account for the losses or unrealized losses that you're incurring. You have to be extremely transparent and net understand that for longevity, you're going to take some paper cuts. You're going to take some hits sometimes. And the faster that you acknowledge them and accept them and work on responsibly rebuilding, the better. That's the first thing. It's a very big acknowledgement in our sector. The second thing, aside from putting in technical guardrails, like you don't want to even give yourself the access to do that.
Yeah.
It's also important to do, and we do this for all our traders, is something called the Myers-Briggs test.
Yeah.
Have you heard of this?
Yeah.
Have you done it?
Yeah. What are you, like a high?
Do you remember
what were you?
Yeah. So I was ENTJ.
Okay.
Yeah. So that specific one naturally considers risk first, which is something I always tend to consider. I'm a risk first kind of guy. Let's assess the risk and then we'll look at the asymmetry and not the other way around. I get the sense that you're the same. Can you remember what your results were?
ENTJ. And like my thing too is it's just like, it's so simple to me that it's like, if you can manage against the risk, leverage is really easy to get.
Dude, you're so right.
It's like if we look at it like a math equation, it's like x plus y squared equals z. It's like, okay, leverage is y squared. So all you have to do is you solve like risk and net return. Like you can pepper as much in it. It's like right now, like I feel very comfortable with managing the risk. I'll release a video kind of the risk. So it's like I'm a little more leveraged than I would if I had a bigger account. But it's like business wise, like I can decide to add a little more leverage because I know I have the risk covered apart from exchange shutdown, and then I have long units. But yeah, that's the way to go. I can't even talk to people that think about the risk though. I don't know if you have someone on your team that's like that.
No, what do you mean? What do you mean?
Like people that want to take the risk, and I was like, dude, just like chill out.
No,
like
no. Yeah, no, dude, we don't hire guys. We don't hire cowboys. Like the moment guys like, yo, but we can make so much. It's like, that's not the point, I actually think, isn't this a great idea? Probably not possible, but theoretically a great idea. I think your leverage should be limited to what your expected value is based on a standardized kind of walk forward optimization and live testing.
See, I go to the worst case type of stuff. So it's like, math is an exact science, trading is an art. So even if you have a 9 sharp, something ridiculous, if you're using 80% of your account, that's like a 600% return from that type of drawdown. So it's like there's no edge in utilizing that much buying power. Where it's like if you could do 40% using 30% of your buying power, you're basically looking at like a 40-ish% drawdown. So it's like in a catastrophic scenario that blew up my account, I'm looking at like 1 year of profit. So I agree with that, but I think 25 to 30-ish% utilization is kind of where it's at, because like those drawdowns you could come back from in absolute worst cases. And it's like also anyone who you were using funds with, it's like if they were in there for a year, they can leave whole basically.
Yeah, that's a good point. And you're touching on volatility drag there as well, no? With
Yeah,
this idea
minus
of, yeah,
33% drawdown equals. And if we want to get really into this, Shannon's demon, it's like if you hold treasuries or if you just hold cash zero yield and then you got 50% returns and 33% drawdowns, also has zero yield. If you rebalance those, you would create edge. Granted, you'd need
yeah,
to create some insane amount of occurrences, but this is why frequency of occurrence and leverage is so attractive because other things that people don't realize, similar in your fund, is it's like if you have a small Sharp but you can exercise that Sharp several times a day, every single day of the year, that zero point 0.5 Sharp actually becomes a 4 Sharp. And the data is going to be
yeah.
much better because you've constantly got it. So if we come back, like this is what I call like portfolio expected value equation, which I think is much more important that people need to think about is it's like, okay, what's your worst case? Because this is like basically your denominator. And then it's like, how much can you mash that probability button?
Mm,
And how much are you excluding from that from when you make money? Because like I'm kind of fascinated with you because I see a lot of people curve fit long options, and it's like, yeah, but if I take away your two best days, you like don't even have positive expected value. And they actually did a study of this at like the University of Iowa or whatever, where they took humans and monkeys and they basically gave them like two cards. One of the cards that they flipped over won 50% of the time, and the other card when they flipped over won 50% of the time. And they measured humans like perspirations, brains, and then their activity. And on average, humans realized after like 30 turns that they had edge in the 55, coin flip. But they determined they wouldn't actually believe it until they were like 60 flips in because,
mm,
humans are made to recognize patterns and they thought they had like some fallacy. And then they did it with a rat or a monkey, I forget what it was. And like 20 trades in, the rat realized they could get food if they flipped it and they just mashed the probability button. So it's like understanding those fallacies, but then
yeah,
having the backstops of that. So like it's like you set your guardrails like 30% buying power. You're always long units, even if it drags 2% for whatever that is. And it's like now you know what blowing up looks like, and you can tell someone that what it is. Like, I don't think it happens. These are all the stuff we do. This is what the exchange goes down. But like you're good and you can like be made whole if this happens. You have the veil of the LLC. And just even the LLC thing is like a huge protection
mm,
for overall capital. It's like I don't think you should allocate all your money to me because like it's just not a good law for business to do that.
yeah, dude, 100%. And I actually had an interesting conversation about this topic exactly with an actuary fairly recently. Because I don't know if you know this, but what you and I do on the quantitative side, remodeling risk, is an actuary's job. This is what they do. The only difference is they use a 95, well, they use a 5% confidence level, basically, which is actually, it's not a lot. Yeah, yeah. It's a 1 in 200 year
If you're
event.
trading every day, it's like it happens every quarter. It's not a lot.
Bro, like we had a ridiculous drawdown this morning. Like it's becoming so common. So I think the way that it needs to be approached is you need to almost think of your fund like an actuary would think of insurance. You need to define what your downside is as a first port of call and make sure that on all levels you're number one transparent and number two protected in some way, shape, or form.
Yeah.
And that's why, I'm sure you've got something similar where it's like this is the max you can lose at this point. Like that's it. It does not get any worse than that. And based off that information, you can go, we've incurred the absolute max that we can. We're going to keep going, or we want to cut the rest of that curve off and we're going to go, look, the model encountered a massive drawdown. We're going to redeem everyone and we can make decisions from there. Like, I find that the bad actors that are attracted to our sector actually just they like gambling with leverage. That's really what it is. And they like the thrill of what we're doing, i.e. that testosterone boost. Whereas the more numbers orientated guys that do this for the skill that is converted into an art almost go, how high can I get this EV while keeping my risk this size? That's where the fun happens. And that's where I think you want to be playing as an investor.
Yeah, and the other thing too is it's like I don't actually doubt people can outperform me or there's people that can trade like that. It's just like it requires an incredible amount of talent and like there's also a bunch of lucky people and bull market geniuses that get weeded out over like a decade to find who those people are. Whereas, I don't want to be the 7 foot tall guy that has terrible shooting form and can't shoot. It's like that's not how I'm trying to be as a trader. It's like you want to be the like fundamentally sound guy that plays defense that can like be plugged in on any sports team and like be a contributor, basically be a coach on whatever field or floor that is. Cause it's like, that is good core habits that can be scaled and across everything. And it's like, I don't know about you, but other thing I'd be curious is like, this all really shifted for me when I started a business because it was like, oh, I am
Yeah.
around people and behaving in a way of like someone at a prop firm that just like wants to get a big bonus. And it's like, it's not their money. Who do they care? It's not their reputation. Where it's like, when you start to do that for yourself and for your livelihood, it's like, this is 100% of your income. It's like, this is what you've thought about and you've wrapped your identity with it. It's like, it's a complete different shift that you're looking at other things almost if you became like a father or something rather than you're just out to get as much as you can. I think a good way to describe it is like you're coming from the primary emotion of ambition instead of greed, but you have to know the difference between those, you know?
Dude, you're so spot on. And this is why I love these conversations, because you're so thought provoking. I think that for me, I had that shift when I realized that I was selling a product. I no longer was using prop trading strategies. I was going, okay, I come from a prop trading background. I feel like these skills can be utilized in a more asset management portfolio context. How do I take this and fit it into this? And when I got to what that is now Athena, I kind of went, okay, Athena is amazing. Like this is such a good idea. And I'm sure you feel the same about your fund, Mark. And you almost go, but for me to keep this amazing thing that I've built, this promise I've made to whoever I've sold this to, I have to stay within these guidelines. The moment I breach that,
Yeah.
there's no coming back from it. You know what I mean? Like there's going to be some outcome, be it positive or negative, that someone's going to look at it if they've got half a brain and go, that sticks out like a sore thumb. Like, how did you get that kind of return on that trade? Or how did you incur that kind of a loss on a trade? Do you know what I mean?
Yeah. No,
And it is the difference between ambition and greed. You spot on.
Yeah, it's cool. It's quite stark. You know, you kind of know almost instantly what it is. But I think that's about an hour, so we put it there. I mean, I'll link your LinkedIn and everything, but anywhere else people can find you, any big plans for Dylan's personal brand coming here in 2025? What does it look like? You know, you got to say it out loud so it becomes real.
Yeah, for sure. I think we're going to be doing a lot more video stuff. So I'm going to be taking notes on your stuff, Mark. We're going to be completing a portion of our equity raise. Super excited for that. And we're going to be entering into the European space fairly soon. Singapore, we're going hard into this year. So yeah, just really excited to meet new people, create new relationships, and obviously scale the fund. Personal brand is also going to be something that's exciting for us. So hopefully next time, Mark, we'll be having you and we can ask you, more insightful questions and get a better sense of your insights.
Of course. Well, pleasure. I'll talk to you later.